Mai aie, mai aie. Mai aie te tipua, mai aie te tahito, mai aie te tākakui o anariki. Mai aie te tawhiwhi atu ki atu, mai aie te tawhiwhi atu ki a rongo, mai aie te tawhiwhi atu ki a tānei. Homi e, hui e, tae ki e. E nā mana, e nā reo, e nā karanga maha o te wā, tihei Māori ora. No mai haere mai, no mai haere mai ki te whanganui a tāra, no mai haere mai ki te pūtia mātua, no mai haere mai ki te hui tēnei rā, tēnā koutou katoa. No rangi ora hau, ko Waimakarere te aua, ko Aureki te manga, kei te pūtia mātua a hau I mahi ana, ko Christian Hawkesby tako ingoa, tēnā koutou katoa. Nō re rā, tēnā koutou, tēnā tātou katoa. So, quick translation. Ants has done a bit of te reo for us already, but that was welcome. Welcome to Wellington, welcome to the Reserve Bank, welcome to this hui, this conference that we're so excited about hosting you all at. Apologies for the cold southerly winds from the south. The sky god Ranganui is telling me that blue skies and warm winds from the north tomorrow for day 2, and that's confirmed by the Met Service. So we're in for a good couple of days. As Adam mentioned, I'm Christian Hawkesby, Acting Governor since 1:30 p.m. yesterday, following Adrian's resignation. He wanted you all to be in the country together to experience this as one. Back in my Bank of England days, I remember Mervyn King was the governor, and he used to talk about monetary policy not being a sprint, but being a marathon around an athletics track, where every 6 weeks, or in New Zealand a little longer over the summer break, but every 6 weeks or so, you work your way around and make the decision for what you want to do with interest rates. So it's a long journey, but I'd say, my view is that if you want to step out of the track and take a break, then what better time to do it than when inflation is right at the middle of the target range, the economy's on the up, and the financial system is in great shape. So I'm delighted that Adrian's been able to finish on that high. If he was here today, he would remind you that he's a serial, or has been a serial returner to the bank. So joined in the 1990s as chief economist, came back again in the 2000s as deputy governor, and then one third time back again as governor in 2018. So he's experienced a lot of that 35 years that we're here to celebrate over these next 2 days, and I think that's really fitting. I also want to acknowledge those of you, and there are many of you in the audience who have been part of this journey. I'm seeing Arthur Grimes, John McDermott, a couple of former chief economists. I want to acknowledge you all in the audience in terms of what you've done and been part of on this journey together. It's really easy to forget how far we've come. You think back to the 1970s and 80s, high and variable inflation, monetary policy tools and frameworks that were not fit for purpose, lack of a nominal anchor in the economy. We lived in a world where there was fixed exchange rate, an unsustainable fixed exchange rate, capital controls, and monetary policy set by direction from the government. Sort of kind of useful to pause on that and remember back to those days. It took a crisis in 1984 for all this to come ahead for us. Classic sort of sovereign fixed exchange rate crisis that many of you will be familiar with, and that really ushered in the reforms of the late 1980s to much of what we see today. A freely floating exchange rate, no capital controls, and a couple of things that were unique at the time. Firstly, an explicit inflation target, and secondly, a central bank given operational independence to deliver on that. In 1988, as the Act was being developed to put this new framework in place, the Minister of Finance of the day, Roger Douglas, stood up in Parliament and said, this new piece of legislation will, quote, ensure that future politicians don't interfere with the primary objective of the Reserve Bank. What a great quote. And here we stand 35 years later. Yes, there have been refinements. Yes, there have been a few little changes along the way. We've evolved, our governance has evolved, and I want to acknowledge my board colleagues and Monetary Policy Committee colleagues in the audience. But fundamentally, we're still at our heart a independent inflation targeting central bank. There have been many lessons along the way. We haven't always got it exactly right. We will never always get it exactly right. We've learned a lot through the Asian financial crisis in the 90s, the GFC through the 2000s, and most recently through the COVID experience. And my colleague Paul Conway, I'm sure, will talk to you about his RAFIMP report, which he's very proud of, which is our 5-yearly review of what we have learnt through that period. We are a learning institution, as Adrian always likes to say. We have also learnt a lot, and this is really a highlight for me in my career, learning from our colleagues and friends overseas. You know, no longer are we out on our own as an inflation-targeting independent central bank. It has become mainstream internationally, and that has meant that there's an enormous amount that we've been able to learn from the direct experience and the enormous academic resources and brain power internationally. And I want to acknowledge and thank those who have submitted papers, those who have travelled to be here with us over these 2 days, those who are going to speak and be on panels and be part of the discussion. So, haere mai, ngā mihi kia koutou. Welcome, thank you so much. So, what am I standing here to do today? It is my huge honour to introduce our first keynote speaker, and now I'm going to, go back on script, make sure I do Dr. Ben Bernanke justice with this introduction. Mr. Bernanke has had an extraordinary career in academia and policy making, where he has shaped economic policy and thought through many US administrations. Dr. Bernanke holds a Bachelor of Arts degree in economics from Harvard University, a PhD from MIT. He first entered academia at Stanford before moving on to Princeton University. So you've covered all the bases in the top world of academia. In 2002, he was appointed to a seat on the Federal Reserve Board. He was subsequently chosen as chair of the US President Council of Economic Advisors from 2005 to 2006. From 2006 to 2014, Dr. Bernanke was chair of the Board of Governors of the Federal Reserve System. So the biggest job in central banking through one of the most toughest periods. During this period, Dr. Bernanke's response to the global financial crisis, and he presided over the subsequent economic recovery. Since he left the Fed, Dr. Bernanke has served as a distinguished fellow at Brookings Institution. Over his career, he has authored on a range of topics as an editor of the American Economic Review, and has published his best-selling book, The Courage to Act. But it gets better. In 2022, we were all delighted when Dr. Bernanke was awarded the Nobel Prize for Economics for his research on banks and financial crises. And as a financial stability guy, that's dear to my heart. Dr. Bernanke recently conducted a review of the Bank of England's forecasting framework. His comprehensive review identified critical areas of the bank's forecasting model and processes that warranted reassessment, offering valuable insights and stimulating discussion across all of the central banking community. Please join me in welcoming our very special guest, Dr. Ben Bernanke.
Good morning. That's the first conference I've ever attended that was preceded by a concert. Well, New Zealand is so different in many ways. So thank you very much for inviting me. It's wonderful to be here. This is my first trip to New Zealand, and it's very much in my heart to talk about inflation targeting, and this is where it started 35 years ago. So I'm going to talk about inflation targeting as a general strategy, and then I'll talk a little bit about the recent global inflation. And it looks like we're going to have time for questions and discussions, so think about what you want to ask, but be kind. I'm a little bit jet lagged. Given where we are, I would be remiss to begin without crediting New Zealand's critical role in developing the basic elements of inflation targeting. The original motivation was chronically high inflation in the 1970s and 1980s, which can be blamed in part on the policies of a non-independent central bank. To address this problem, in 1986, Minister of Finance Roger Douglas invited officials to consider changes to the monetary framework. The key elements identified over the subsequent years, as formalized in the Reserve Bank Act of 1989, included operational independence of the central bank, a focus on price stability. Prior to that time, the central bank's policy goal had been ill-defined, and importantly, a transparent approach that would foster public understanding and political accountability. Price stability was defined to be between 0 and 2%, and there was an expectation that repeated failure to meet that target would cost the governor their job. As with any major disinflation, anchoring the public's inflation expectations at a low level was a key challenge, but within a few years, monetary policy had succeeded in bringing inflation down from 19% in 1987 to only 2% by 1991, and establishing a new monetary policy regime. This success was not without costs. Like the Volcker disinflation in the US in the early 1980s, unemployment rose with the tightening of monetary policy. Given the country's previous record of inflation, the employment effects of the transition, though painful, were not unexpected. Since its adoption by New Zealand and its successful application here, inflation targeting has become the dominant strategy for monetary policy around the world. With a few differences in details, it is now the policy framework for essentially all advanced economies, as well as for many middle-income and emerging economies, such as Brazil and Mexico. China, where the central bank must answer to the political leadership, is the principal exception. Despite this near universal adoption, I think there remains some confusion, even among economists, about exactly what inflation targeting is and how, in most cases, it leads to better policy. In one of my earliest speeches as a member of the Federal Reserve Board of Governors in 2003, before inflation targeting was adopted in the United States, I commented that, quote, "Discussions of inflation targeting in the American media remind me of the way some Americans deal with the metric system. They don't really know what it is, but they think of it as foreign, impenetrable, and possibly slightly subversive." It took 9 years from that speech, but in 2012, inflation targeting became the official framework for US monetary policy. And today, the Federal Reserve's 2% inflation target is well understood by financial markets, legislators, and other observers. A few words on what inflation targeting is not. It is not a commitment to achieve a certain level of inflation without regard to other economic objectives. Yes, low and stable inflation is important for healthy growth and for market efficiency, and the central bank leads in the battle against inflation. But to varying degrees, all central banks care about employment and growth as well. The Federal Reserve, in particular, has long had an explicit dual mandate to maintain both price stability and maximum employment, which inevitably implies trade-offs. The reason the Fed does not have a numerical goal for, say, the unemployment rate as well as the inflation rate is that the sustainable or so-called natural rate of unemployment is neither constant nor directly observable. Central banks whose primary mandate is price stability, like the European Central Bank and many others, focus on inflation but are attentive to the economy's real side and are open about the fact that they take growth and employment into account when setting policy. Reflecting this reality, a term that is often used, I throw it up on the screen, is flexible inflation targeting, meaning basically that the central bank will consider deviations of employment and growth from sustainable levels when determining how quickly or aggressively policymakers act to return inflation to target. Another red herring, don't know if you use that term in New Zealand, is the ongoing debate about the specific choice of target. Why 2%, which is the number which is used by most inflation targeters? And why choose one measure of inflation rather than another, when all measures are flawed to some degree? For example, in that they include necessarily imperfect quality adjustments and other imputations. The measure of inflation the Fed uses, for example, puts heavy weight on the imputed rent of owner-occupied homes, a price that nobody actually pays. But if you're going to have accountability and transparency for monetary policy, you have to pick a specific index and a specific number. For me, 2% seems a good compromise in that it keeps steady-state interest rates a bit higher than the zero target would, giving the central bank more room to cut rates in a recession while being low enough that households and businesses do not need to think about inflation too much in their economic activities. We have recently had a good object lesson on how households and voters feel about high levels of inflation. History also matters. If the central bank has delivered, say, 2% inflation for a long time, and inflation expectations are anchored at that level, the cost of changing the target could be large. All that said, central banks have made different choices regarding their target, and I think that's totally fine as long as they're transparent about it. I'm even open to ideas like nominal GDP targeting, although it's notable that no central bank has experimented with that approach. So, stripped to the essentials, what is inflation targeting and what is the case for adopting it? As I argued when I was advocating for inflation targeting in the United States, inflation targeting is both a policy framework and a communication strategy. By policy framework, I mean the principles by which policymakers decide how to set policy. I note that the Fed's Federal Open Market Committee has a formal set of policy principles that it discusses and votes on every January. I see inflation targeting and related approaches as a compromise between two polar approaches to policymaking. At one pole are strict policy rules, like the Taylor Rule. In principle, policy rules provide a guide for how to set policy as a function of a few simple variables. In the case of the Taylor Rule, for example, the current deviations of inflation and unemployment from target. One benefit of rules is that they provide a benchmark for policy based on actions taken in similar circumstances in the past and whose outcomes we know. According to advocates, though, the main benefit of rules is that they discipline the policy committee and prevent short-sighted behavior. For example, in principle at least, following a rule prevents politically influenced policymakers from juicing the economy, say before an election, knowing that the inflationary effects of over-expansionary policies are not likely to appear until later. The Federal Reserve publishes the recommendations of various policy rules in its semi-annual report to Congress, and those recommendations are often part of the discussion around the FOMC table. At the other pole from rules-based policy is purely discretionary policy, in which the policy committee evaluates the outlook at each meeting and then decides how to set interest rates. This approach has the advantage of allowing greater scope for the judgment of policymakers. Circumstances change, the economy evolves, there are always many factors to consider. With discretion, policymakers are free to assess and to respond to changing conditions. Also, unlike rules-based policy, which usually ties policy rates to current values of the goal variables, discretionary policy can freely incorporate forecasts of key economic variables into policy decisions. Discretionary policies have weaknesses as well, however. From the outside, they can appear arbitrary, undisciplined, and hard to forecast. Moreover, as rule advocates often point out, purely discretionary policies are subject to the so-called time inconsistency problem, the incentive to overstimulate the economy in the short term to promote a near-term increase in output and employment. As theory and practical experience have shown, this strategy is ultimately self-defeating, since the public will eventually begin to expect the high inflation. Indeed, if inflation expectations adjust sufficiently, the central bank may no longer be able to get short-run output gains, even if it loses control of inflation. Arguably, as I mentioned, this problem led New Zealand to adopt inflation targeting 35 years ago. Inflation targeting and related regimes occupy the middle region between rules and discretion. In a 1997 article, Rick Mishkin and I called inflation targeting a form of, quote, constrained discretion, and argued that that approach strikes a balance between the inflexibility of rules and the lack of discipline inherent in a purely discretionary approach. Under flexible inflation targeting, policymakers can use all available information, including forecasts, to try to stabilize output and employment in the short run. This is the discretion part of constrained discretion. On the other hand, even as it reacts to currently available information, an inflation targeting central bank is constrained by its public commitment to keep inflation low and is stable in the intermediate term. An advantage of this approach, beyond the flexibility to react to short-run disturbances, is that a demonstrated record of achieving the inflation target over the medium term will tend to anchor inflation expectations, which makes inflation itself easier to control. Of course, a central bank could announce an inflation target and proceed to ignore it, but in practice, that is a rare occurrence when a central bank is operationally independent. Central bankers realize that a reputation for meeting their commitments is a capital good, which can depreciate quickly if they don't follow through on their promises. Inflation targeting is also a communication strategy. As Mishkin and I emphasized in our advocacy of this approach, and as the original New Zealand framework recognized, simply announcing a target is not enough. A high level of transparency, especially concerning how and by when the inflation target is to be reached, is essential for several reasons. First, explaining in detail the central bank's plan for achieving the target, besides reducing uncertainty, makes achieving the target easier. If the public understands and believes the policy plan, then inflation expectations will tend to be well controlled, and prices in financial markets are more likely to evolve in a manner consistent with the plan. Clarity about the strategy and about internal debates about the strategy also help the public understand and predict how policy is likely to change when, as almost always happens, the world evolves in unexpected ways. Second, transparency fosters both independence and accountability. Inflation targeting central banks are usually operationally independent, and the existence of an official target strengthens their independence by setting a goal that is observable to the public and is not influenced by short-run political considerations. But the opposite face of operational independence is democratic accountability. An inflation targeting central bank has public objectives. The public and the legislature have a right to be assured that the central bank's plan for achieving those objectives is reasonable and realistic, which requires an open and transparent approach by policymakers. In fact, the adoption of inflation targets has proceeded in parallel with steps away from traditional central bank secrecy toward a much more transparent approach to policy in general. In my own country, before 1994, the Fed did not even make a public announcement when it changed its stance on monetary policy. Today, as at most central banks, the Fed issues a policy statement after each meeting, and the chair holds a press conference to provide context for the decision. The projections of policymakers for macroeconomic variables, including the policy rate, are released at the same time, and minutes of the meeting are released 3 weeks later. The chair and other policymakers give public testimony and speeches about the outlook for the economy and policy. Most other inflation targeting central banks, including New Zealand, do all these things and sometimes more, such as releasing a monetary policy report that includes an official baseline economic forecast. Purportedly, the slogan of Montague Norman, the governor of the Bank of England in the 1920s and 1930s, was, "Never apologize, never explain." Today, there are at times so much communication from central banks that market participants complain about what they call cacophony. So how has inflation targeting worked out? It's only a framework, and it does not prevent policy mistakes or eliminate the possibility of major shocks like the financial crisis or the pandemic. It does not even guarantee low inflation, as the past few years have taught us, although central banks around the world responded strongly to the pandemic inflation shock and seem on the way to restoring price stability. But compared to the more discretionary and less focused policies of the 1970s and 1980s, it appears to have increased the predictability of policy, lowered inflation on average, anchored inflation expectations, clarified the goals of the central bank, and increased democratic accountability while strengthening, at the same time, central bank independence. These goals are similar to what the New Zealand government had in mind when it instituted inflation targeting in 1990. So where does inflation targeting go from here? Certainly, one important objective is to learn what lessons we can from the recent bout of inflation in virtually all major inflation targeting countries, except perhaps for Japan, which faces a different set of challenges arising from its macroeconomic history. Your view on the lessons of the pandemic inflation depends importantly on your view of what caused that bout of inflation in the first place. There's plenty of controversy about that question, and I'm sure that will continue. Some argue that the large fiscal programs put in place to help insulate the public from the effects of the pandemic caused the inflation. It is true that those packages were historically large in many countries. In the United States, the headline numbers of the fiscal packages suggest that those COVID-era packages in 2020 and 2021, measured relative to GDP, were nearly 5 times the size of the fiscal program instituted in 2009 by the Obama administration in the wake of the financial crisis. That said, I'm not persuaded that fiscal policy was the principal culprit for the inflation, at least in most countries. In the US, although the COVID fiscal programs were large, not all the money that Congress allocated was ever actually dispersed. Some was spent only with long delays, and much of the money that did reach the public was saved, to be spent slowly over several years. The high rate of saving of the government's aid was perhaps to be expected, since unlike most relief programs, much of the government money went to higher income people and to businesses whose marginal propensities to consume are presumably lower than those with lower incomes. Retrospective estimates by the US Congressional Budget Office find that the output gap in the United States during the COVID period was relatively moderate and much smaller than in 1967 when the great inflation of the 1970s was taking hold. Moreover, the available evidence suggests that the Phillips curve is much flatter today than it was in the 1960s and 70s, implying that a given output gap should produce less inflation than it would have 60 years ago. So what caused the inflation? Work I've done with Olivier Blanchard finds that in the United States, the bulk of the inflation either originated on the supply side or had important supply side components. Energy and food prices, reflecting commodity prices determined in global markets, drove much of the inflation, both in the US and globally, with Europe being hit especially hard by a spike in the price of natural gas. At first, commodity price increases probably reflected a global recovery from the pandemic that was earlier and stronger than expected. But by early 2022, Russia's invasion of Ukraine was clearly also a big factor. Supply chain issues, together with a pandemic-era shift in final demand from services to goods, also contributed to price increases. Evidence for a large role for supply-side factors is the fact that most economies face similar levels of inflation independently of their fiscal choices, and that the inflation in the United States and many other countries appears to be subsiding without a significant increase in unemployment that some predicted. A relatively painless disinflation is what one would expect if the inflation were caused mostly by temporary supply-side factors. True, inflation is not yet at target in many countries, but my paper with Olivier did predict that the, quote, last mile in the fight against this burst of inflation would be tougher, as demand-side factors at that point would probably be making a relatively larger contribution. Now, I don't know much about New Zealand, but I'm going to say something anyway. New Zealand appears to have had an inflation experience that in broad strokes was similar to the US and other countries, with supply-side and external factors playing important roles and the central bank responding actively. However, it is true that fiscal expansion in New Zealand was greater relative to GDP than in many other countries. Replication of the Bernanke-Blanchard model at the Reserve Bank accordingly finds a relatively greater role for aggregate demand growth and labor market overheating in New Zealand's inflation, which in turn could help explain the higher cost of this inflation here as measured in terms of job losses. Based on my work with Blanchard, as well as a review I did of forecasting at the Bank of England, My overall conclusion is that in terms of actual policy choices, given that they saw a large supply-side component of the inflation, most central banks did about as well as they could in terms of actual policy choices. Standard monetary policy doctrine holds that policymakers should not try to completely offset supply shock effects. Doing so would be too costly in terms of output and employment, but should emphasize instead the stabilization of the public's inflation expectations. The Fed and other central banks seem to have been successful in moderating the rise in longer-term inflation expectations despite the inflation surge, and the tightening of policy that did occur likely offset some of the demand-side pressures that arose from the fiscal stimulus. If there's a lesson from the recent inflation, I think it has more to do with communication. The tendency of the Fed and most central banks is to focus on the modal or most likely economic forecast with the implied policy strategy. In the United States, that tendency is reflected in the so-called Summary of Economic Projections, which features the median projections of FOMC participants for growth, inflation, unemployment, and the policy rate. In other countries, this tendency is reflected in the emphasis typically given to the central or baseline forecast. The problem with this practice is that the economic outlook is always very uncertain. The baseline outlook is just one of many possibilities. I think a key lesson of the recent experience is that central bank communication should put greater weight on the possibility that outcomes can be quite different from the modal expectation, and that if the reality is different from the forecast, monetary policy will respond quickly and appropriately. To illustrate, in the United States, although the FOMC acknowledged the uncertainties in the outlook, in 2021, the Fed focused the public's attention on their forecast that inflation would most likely prove, quote, transitory. As already noted, this was especially evident in the projections of the economy and policy rates made by FOMC participants, which focused markets and the public on the median outlook. When the inflation proved not to be transitory, it hurt the Fed's credibility, and more seriously, the public was not well informed in advance about what the Fed's response would be once the baseline forecast proved wrong. With hindsight, a better communication strategy might have been for the Fed to say that the baseline forecast envisioned transitory inflation, but to emphasize more strongly that other outcomes were certainly possible. And if they occurred, here, in general terms, is the way that policymakers would expect to respond. The same strategy could have been used to illustrate in advance the conditions under which quantitative easing would have been ended at about the same time. The issue is a very general one. I talked about it a lot in my review of the Bank of England. During my own tenure at the Fed, for example, being more explicit about providing alternative economic scenarios and clarifying how policy would react in each case could possibly have helped avert the 2013 taper tantrum. In short, communication could be more effective if policymakers would put greater emphasis on the inherent uncertainty associated with any economic forecast, supplementing the baseline forecast with more attention to possible alternative scenarios for the economy and for policy. Going forward, the world will face new challenges, and no doubt the monetary policy framework will evolve further. Like you, the Federal Reserve is currently in its review of its framework. It's a good thing that the Fed, the Bank of Canada, the Bank of Japan, the Reserve Bank of New Zealand, and other major central banks do conduct these periodic reviews, trying to improve, understanding that nothing is completely permanent. I hope and believe, however, that even as these frameworks get a close look, that the key elements of inflation targeting, which I include clear goals, transparency about policy strategy, and operational independence with democratic accountability, will all persist. Thank you.
Okay, so now we have about half an hour for a Q&A with Dr. Bernanke. So we've got a couple of roving mics, one here and one here. So yeah, just raise your hands and I'll collect maybe 2 or 3 questions at a time. So we have Enrique up the front here and Patrick just in the middle over here as well.
Please speak clearly.
So Enrique here.
Thank you so much. This was a very interesting presentation. By the way, my name is Enrique Martinez from the Dallas Fed. If I may, I would like to hear your thoughts or to push a little bit on the narrative of the global inflation post-pandemic. So one of the stories that has been advocated is that there might have been a role for a steepening of the Phillips curve. You have argued for the supply side factors. How much credit or how much weight do you put to the potential steepening of the Phillips curve as part of the story?
Cool. And do you want to add yours, Patrick, and then we can
Yes.
sort of take them together?
So much has been said about the importance of monetary policy independence. I would like to understand a little bit better what's or should not financial stability regulations have the same kind of insulation. And on top of that, I could notice that the Trump administration has recently insulated the independence of monetary policy of the Fed, but not financial stability. So that's the background.
Okay. Good questions. So on the nonlinearity of the Phillips curve, there are a number of papers out there, I'm sure you know, that purport to have found that. And it's, I guess, logical because there wasn't much excess employment and inflation went up a lot, so it seems to fit if you ignore supply side factors. My problem with that, and I'm open-minded, but my problem with it is that we have no observations. I mean, this is the only inflation in the United States since the 70s, and the world has changed a lot since the 70s. And so I think it's just too simple. When we found, Olivier and I found that when we stuck in measures of labor market tightness into our inflation equation, like the vacancy to unemployment ratio, for example, it was linear. We found it to be linear. Once you control for the supply shocks, so that's the key thing. So if you're not controlling adequately for supply shocks, you're going to get nonlinearity, but I don't necessarily find that entirely convincing. But again, my problem is that there's just not enough relevant data, at least not in the United States. And of course, countries have different labor market institutions as well. On financial regulation independence, that was your question. So this is a big debate. Well, debate. The president is trying to reduce the independence of so-called independent agencies in general on the theory that the executive should have control over all agencies that are carrying out the laws. And there's some legitimacy there in that, you know, Congress frequently just gives a very general guideline to the agencies, and the agencies then have a lot of flexibility to, say, Basel III or whatever it might be, and it's difficult for banks, et cetera, to get their concerns heard. So it's not a completely crazy case. However, there's good reason why agencies like the FBI and the bank regulators, et cetera, are independent, which is that you want to, just say reason is for monetary policy, you want to preserve some space between those agencies and the political process. Without naming names, when I was Fed chairman, I got a few calls from congressmen saying, you know, my buddy Joe, his bank is being investigated. You really ought to call those guys off. And I would say, thank you, Senator. I appreciate the input. But naturally, you couldn't, that would be corrupt to do that. And so that's the trade-off. And I think it is important that decisions, administrative decisions about prosecution, about regulation, et cetera, that Congress specifies clearly as it can what it wants, not specific to any one company, and that the agencies carry that out in an impartial and non-political way. And that's a very difficult balance to achieve. I guess I would add on the regulations front, the US regulation system is pretty nuts, actually. One very simple explanation of the financial crisis in the US is that there were 4 agencies committed to studying the safety and soundness of the banking system. And all the problems occurred in the so-called shadow banking system, which had no safety and soundness regulators. And there's an accident of history. I could tell you what happened in the Roosevelt administration and how things came to be that way. But another aspect of this is reassigning agencies to a set of responsibilities which are mutually consistent and which cover the field and adapt to changes in the economy and the financial system. So these are really important questions. A good question.
Warwick, and the side of the room's quiet, and Paul down here as well.
Thanks, Ben. That was a wonderful presentation. One thing you didn't mention was the theory of R star, and I just wondered, there's a great paper by Adrian Pagan, which is called The Search for Stars, and he points out that the R star is almost impossible to know what that is, yet the media and there's a literature that people are looking for R star. I wonder if you would make a comment. Do you think it's a useful concept, or is it just really undermining the debate on monetary policy?
Well, R star, one of Jay Powell's best speeches early in his tenure was at Jackson Hole. It was called Navigating by the Stars. And there he talked about R star and U star, the natural rate of unemployment, and Y star, potential output. And he said, well, you know, we're supposed to navigate by these stars, and we can't see any of them. It's a foggy sky. and that's a real problem. It's a very real problem. But if you think logically about monetary policy, if it's going to stabilize the economy, it has to have some concept of what equilibrium looks like. So where is the Fed's interest rate finally going to settle? And what interest rate is consistent with a long-run equilibrium in the economy? You can't think about that question unless you have some general sense of what R star is. So it's a very difficult, and same with U star. I mean, the Fed is now saying that the labor market is no longer contributing to inflation pressure. How do they know that? Well, because we're close to U star. So it's a very tough problem. Now, I would disagree, though, with the idea that we don't know anything about R star and these other measures. For example, there's a massive literature, of course, and there are two very general sets of guidelines that you can use on R star. One has to do with the idea that R star corresponds to a stable economy. So there's the work by Laubach and Williams, for example, that says, well, what interest rate is consistent with an economy which is more or less stable, which is the original Wickselian view of R star. And they have, based on that, they've gotten estimates, and they seem to put the Fed seems to put a lot of faith in those estimates because they seem to explain the estimates you get from the summary of projections. The other way to do it, which is also imperfect, of course, is to look at term premia, to look at the term structure of interest rates. Presumably, investors have some idea. If you look at the 5x5 forward interest rate, it must have something to do with R star, right? Because what it is, by definition, is R star plus a term premium. And if you're able to model the term premium, I'm not saying it's easy, nobody's been very successful at it, then that could give you a clue too. So if you do that and you look across countries and you apply some other kinds of modeling techniques, you can get yourself within a range, I think. But a lot of the uncertainty about making monetary policy does, as Jay very correctly pointed out, comes from the difficulty of knowing the stars. And, but you can't ignore them. You have to think about them. And if you read his subsequent speeches and outlooks and so on, he talks very frequently about some of these concepts. And so he's not entirely taking his own advice.
Paul?
Paul Bloxham from HSBC. Thank you for the speech. I really enjoyed it. Could you expand a little bit on this idea of focusing on a modal versus a median forecast? Because, I mean, it makes sense to me that in a world of greater supply shocks, or maybe more regular supply shocks, obviously we're dealing with US policy changes that are quite rapid at the moment, that you might want to set out a set of modal views and scenarios. But I want to reconcile how I fit that with using forward guidance as a tool for conditioning market expectations. And I want to give you one more remark, and that is in the context of this country, which publishes every quarter a single path for where the cash rate's expected to be headed based on the central bank's view. From a communications perspective, how do you actually mechanize making it as useful as possible, but still focusing on scenarios and modal outcomes?
Well, you need a baseline forecast to start from. There are central banks, I think Sweden might be an example, that do, New Zealand, that do use models to figure out alternative scenarios. What happens if the energy prices do something different than what's in our modal or median forecast? By the way, modal versus median, I could go on that for a while, but basically, just a comment is that what the markets are looking at really is something mean. It's really the mean forecast, because that's what the average outcome is in the market. The modal forecast could be completely different from the mean. Anyway, I just think that, I talked about this a lot in my review of the Bank of England, that they put such a very heavy focus on the baseline forecast, including doing something the Fed never does, which is talking a lot about the details of the baseline forecast in the post-meeting statement. So it's very heavy emphasis on that forecast. And the public, what is the newspaper story going to say? Bank of England or Bank of New Zealand sees 1% growth in the next 12 months. Okay, and what happens if it's 2% growth? Well, they were wrong. Yeah, well, I guess so, but probably the economists would say, well, they were within the standard error bands and so on. So anyway, I'll give you the example of, I was talking about my own little brush with communications problems in the taper tantrum. One problem there was we didn't ever specify really, there are two contingencies in which we might stop buying assets in QE3. One was that it just wasn't working. The labor market was, what we said in the statement was we were going to continue to buy until there was a substantial improvement in the labor market. Okay, well, what do you do if it never improves? So you should to avoid a trap, it would be nice to say something about, here's the scenario where it doesn't improve for some reason, maybe U star is higher than we think, and here's how long we would go before we would stop buying assets. On the other hand, maybe unemployment would drop quite quickly, and it might have fallen, a couple hundred basis points, and how far would it have to drop before we say declare victory? We never specified. So what I'm saying here, and using myself as or my committee as a example, by talking about, by making people understand how very, very uncertain economic forecasting is, and it is really embarrassing how uncertain it is, and making people understand that you don't have a policy plan that's written in stone, we're going to cut interest rates 3 times next year. It is instead contingent on what happens in the economy, and here's how we're going to react to different contingencies. And I think that protects the central bank a little bit from, misconceptions about plans. I find it really interesting that the Fed, for example, simultaneously puts out 3-year forecasts of the federal funds rate, and then says also we're data dependent meeting by meeting. Those two things are not consistent. So, I don't mean to be critical of the Fed. Media, do not say that. I'm not critical at all. I think the Fed has done a good job, but it just is, the issue is trying to explain how you behave in off the equilibrium or alternative scenarios, which of course always occur.
Just one question over here.
Thanks. Ben Arthur Grimes, a former Reserve banker. I've got a normative and a positive question that are related to each other. The normative question, and just a bit of historical background, when we were putting the Reserve Bank Act together in '89, there was a big discussion as to whether the inflation targeting should be just of consumer prices or should also include asset prices. So the wording in the Act was the stability in the general level of prices, which was vague enough to include both. And subsequently, it became consumer prices in the policy targets. So the normative question is whether central banks should target asset prices as well as consumer prices. And the positive question is, in the most recent episode, the COVID episode, do you think that monetary policy affected the trajectory of asset prices, especially real asset prices, In New Zealand, if you look at house prices, they increased by close to 50% during that period. Huge, the largest in the world. And that increase, the trajectory of house prices mirrored the trajectory of the Reserve Bank's balance sheet. So the normative question is, should central banks have an asset price as one of its components of its targeting regime? And the second part is a positive question, did central banks' policies affect asset prices through COVID?
Well, should they include asset prices in their inflation target? I would say no. And the reason is that asset prices are a different animal from what people pay, for their daily living costs. Besides the fact that they're highly concentrated, of course, et cetera. But beyond that, when the price of a stock goes up, it's more expensive to buy stock. That's true. But the person who owns the stock is better off, right? It's the same way with houses. For a long time, there were attempts in the U.S. to include house prices in the inflation index, but that was logically wrong because, again, if I live in a house and my price of my house goes up, I'm probably better off, really, not worse off. So I would say no. I would say that you should aim at the consumer prices, which are a different thing, and also certainly more amenable to monetary policy than asset prices. On targeting asset prices, I think also that's not a good idea. And the example I would give you would be 1929, when the Fed said stock prices are too high, let's get them down. They did. So, things can go very badly wrong if you try to do that. Now, what you want, of course, is financial stability. You want the financial system to function well and to provide the services that it's supposed to provide. And the way to do that is to have, sorry to be boring, good oversight, good regulation, safety and soundness, making sure your system is robust, stress testing it in various ways, making sure that safety and soundness considerations are everywhere. We learned 1987, good example. Stock prices fell 23% on one day. Didn't do much to the economy, So there's a very loose connection between asset prices and the real economy. And of course, the Fed looks at financial conditions, quote unquote, and that takes that into account in their forecasting. But I think financial stability is the goal, not a certain level of asset prices. And to achieve financial stability, the first and most important step is to make sure that you have a resilient system with sufficient capital, with good risk management, that where there are not too many dark shadows that are operating without oversight. So that's how I would approach that.
Can I just get you to answer the second part of the question? Do you think monetary policy did affect asset prices through the COVID period, especially house prices?
Should it?
Did it? Did it?
Did it? Oh, yeah, sure it did. So mortgage rates in the U.S. were, 2.5%. Now they're 7%. Obviously, that's going to affect people's willingness to buy houses, even though house prices have still been going up. But there were other fundamental factors as well. So we're still trying to understand how the COVID pandemic has changed the American economy and other economies. One of the effects is that, at least currently, although the current administration is trying to change this, about 30% of the public works at home, and at least some of the week, And no matter how you feel about that, if you work at home, you would like to have more space. You might prefer to you make a different trade-off in terms of commute time versus, having a yard and those kinds of things. And so it did increase the demand for living space, and that was part of it. So there were some fundamental factors as well. But low interest rates, no doubt, affected it. So then the question is, you say, oh, well, that creates a financial risk, right? Well, maybe it depends on whether or not the underwriting is good or not. So in the subprime mortgage case, I've heard the case made, well, the Fed had low interest rates, and when it rose interest rates, all these adjustable rate mortgages went bad, and so it's the Fed's fault that the subprime mortgages went bad. And my answer would be, why are people writing 30-year mortgages based on a 1% interest rate? You know, I mean, good underwriting, which takes into account different scenarios, if you don't mind me using the phrase again, will address a lot of those issues.
Cool. We had a question from Chris and Marie at the front here.
Chris Wall, Reserve Bank of New Zealand. So over the last 7 years, the Reserve Bank's moved from a primarily inflation targeting through to a dual mandate and then back to primarily inflation targeting. And I was interested in your thoughts on the differences between the two, so inflation targeting versus a dual mandate.
Yes, do you want to hear the other question as well?
Yep, just up here.
Thank you, Dr. Bernanke. Mine's kind of couched from coming from a developing country where there's constant supply shocks and constant structural change, and actually a world now that we're entering that we're all going to be experiencing the same thing when we think about climate and the contribution of US policies that's probably going to accelerate those impacts and structural change. I guess we're entering a world where we're all doing monetary policy under increased uncertainty or heightened uncertainty. Do you think that the average inflation targeting framework is a little bit more forgiving then, when recognizing we're going to be wrong more often, perhaps, so you can kind of make up for it? And then do you have a view on what that tolerance band should be, or what horizon we're thinking of when we're thinking about average inflation targeting? Thank you.
So on the dual mandate question, this is an empirical question, because banks that are supposedly pure inflation targeters, there is no such thing as a pure inflation. At least there is not one in the world that I'm aware of. All inflation targeting central banks do pay attention to employment. And by the nature of the system, employment may or may not still be true, but the conventional wisdom is that employment responds more quickly, and therefore needs to be addressed, more in the short term, and inflation expectations are more of a longer term issue. So, like I said, flexible inflation targeting, which is what everybody does, says that we try to moderate the speed of our return to the target, et cetera, depending on the state of the economy. So there's an empirical question, and we were talking about this before the meeting started, which is there any real change in behavior when you go from a dual mandate to a single? I would argue, my guess, I haven't done the work, somebody could easily do this work, I would guess there's not a big change in behavior, that pure inflation targeters still are looking at employment and output, and that's factoring into their policy making. On climate change, it's a tough question. Volatility comes from lots of places. It comes from markets, it comes from geopolitical issues, et cetera, et cetera. Now, the United States has suffered quite a bit from climate problems. We've had wildfires, we've had flooding. We've always had hurricanes and earthquakes. I don't know, sometimes you feel like you're under siege there. But it's quite rare. I mean, honestly, at this point, it's quite rare for one of these events to push the whole macroeconomy, off in a significant direction. I remember I was on the board when Katrina, the hurricane, hit New Orleans and almost destroyed the city, and we were very concerned about the functioning of the banking system and wanted to be sure that there was, adequate, money, currency flowing in, et cetera, et cetera. But it didn't really change the monetary policy path, that we were on. Now these things, of course, over a longer period probably will change the macro approach. For example, even putting aside the United States, there's a lot of investment in green technologies and so on, which will, on the one hand, probably lower energy costs at a certain point and will probably reduce volatility at a certain point. But these are sort of long-run things. And the thing about central banks is that they are really mostly, except for expectations and so on, they're mostly about looking at the next year or two, basically because their forecasting is so problematic. So there are many reasons for why the global economy could be more volatile, and the central banks will take those into account the best they can, but I don't think it's going to change the framework. And in terms of inflation targeting, again, the flexible inflation targeting says, let's look at everything and adjust our return to the inflation target so that it's consistent with all our other objectives, whatever they might be. So you're asking about flexible average inflation targeting. So this was brought in because of concerns about the zero lower bound. And so the idea was you would overshoot the target to give you sort of an average rate. It's actually related to price level targeting, which is a different approach. I think the trend is towards, I think average inflation targeting will still be a possible structure, a possible response to hitting the zero lower bound, but that somehow seems a lot less relevant than it did 10 years ago. So the more likely scenario is a more balanced approach where you're sometimes above, sometimes below, but it's more or less equal.
So we have Dominic with a question, and then one from Renee up the front here.
Hi, I'm Dominic Stevens. I just want to come back to the start of your presentation where you talked about the importance of central bank operational independence. In New Zealand's case, the target for the operationally independent central bank is renegotiated. Actually, the convention seems to have become after every election. So we've actually had moves in the target in both directions, but in general, they've been more often looser rather than tighter. So we now have a higher inflation target with more sort of exceptions and other things to look at than we had at the start of inflation targeting. It strikes me that, at least in theory, the incentive is for an incoming government to loosen rather than tighten the target for the duration of their 3-year term in power. So do you think there's a risk that we've actually, there's a vestige of the time and consistency problem still remaining in our system? And if so, what could we do about it? And I was also wondering about a comparison to the United States. Is it possible that a similar phenomenon could occur there?
Should we take Renee's question as well?
Thank you. I'm Renee Fry-McKibben. I did the review of the Reserve Bank of Australia, and I was one of the reviewers. And we also recommended scenario analysis by the bank. But I get a lot of, every now and again, some pushback on that, in that there are so many scenarios. How do you choose which ones are important? So I'd be really interested in your take on how do you actually do that?
Well, on your question, so the alternative to say, we know what's going to happen, inflation is going to be transitory, full stop. I don't think that's very credibility enhancing either. Sometimes the alternatives are fairly obvious. Supply shock has occurred, it may be extended or it may reverse. Here are the obvious possibilities. Something that, Catherine will remember, when I was looking at the Bank of England, one of the issues that they were talking about a lot was how persistent was the inflation process. Would it react quickly, or was it becoming ingrained in the wage price process? That's an alternative scenario. Why don't we look at the scenario where inflation is more persistent, and how would we react to that? So I think that you don't want to, obviously there are limits to cognitive, the ability of the public to understand how many you're putting out there. But in most cases, I think this has not been adopted in a full-scale way by anybody, so we still have to see the practical experience. But in most cases, or many cases anyway, there seems like an obvious alternative to the baseline. And it could be just as simple as, aggregate demand is going to be stronger than we thought. You don't have to specify why exactly. And here's this, and by showing you the difference in the rate path, that tells you something about the reaction function. So you're able to teach at least the more sophisticated observers, how you're thinking about the alternatives. So I think it is important to pick just a few and try to find ones that, for one reason or another, are relevant to the current situation. But I think also part of this is just getting people to understand that we don't know for the next 3 years what the rate is going to be. We have different contingent strategies depending on what happens, and here's how we're thinking about the different alternatives. And people start thinking that way, it'll be a little bit, I think it would be a little bit more healthy. On the government setting the target, that's an interesting case. A number of central banks set their own target. The Fed set its own target. The European Central Bank sets its own target. It is true that in the UK, and Catherine can again correct me, but there's this idea that if the inflation rate goes too high, the governor has to write a letter to the prime minister or the chancellor of the exchequer explaining, why it happened and what you're going to do to get it undone. So there's a certain amount of input. So you could argue that part of that is just accountability, right? So you're giving it operational independence, and what is the objective? And so there's a certain argument on the one hand that there are technical considerations, and that would argue for the central bank dominating the decision, but there are also democratic accountability considerations, and that would say the government has some role. I don't see this as a big problem, frankly. I mean, I don't think any government would come in and say, well, we'll make the target 5% for the next year, or something like that. I mean, the thing is, it's public and people see it, and all the politicians in America are running on, I'm going to get inflation back. I'm not going to get inflation down. I'm going to get the price level down. You don't know what a big deal the price of eggs is in the United States. Boy, it is a big deal. I think pretty soon they'll be importing eggs from somewhere, so anyway, it's a good question whether or not the government should be part of that decision process. I don't see it as a major destabilizing factor, particularly since the central bank is free to complain. If it gets really off the track, 5%, we don't think that's consistent with price stability.
So we had Les with a question, and then Catherine up the front.
Good morning. I'm Les Oxley from University of Waikato. I'm an academic, not a Reserve Bank ex-employee. Great talk, and you touched upon a number of areas of expertise that many of us as individuals don't have, and I want to frame my question around that. I've taught first year macro for probably 15 or 20 years, and I found it almost impossible to get students engaged with theories of inflation. So COVID to me has been one of these sort of natural experiments which have given me, some potential to engage with people. But as you answered one of the questions previously about the Phillips curve, we don't really have enough data to be telling us what's happening to the Phillips curve. In terms of how I try to motivate, and here I'm going to try and pick your brains, motivate students, it's very hard unless they've experienced, to have a life experience of inflation. And I'm not encouraged as an academic to teach my students things that are not relevant to them. But clearly I think we've made some mistakes, and we've made mistakes in not giving our high-level economists, in terms of our graduates, an understanding of economic history. And we're sort of repeating many of these sorts of ideas. You've alluded to the 1930s, and your work has been reinterpreted many times. So, first of all, as an opinion, do you think that we need to enrich our teaching of, or reinvent our teaching of macroeconomics? many of my students, ex-students are here, and they're smart. They understand, but I'm teaching people who are going into business, and they're less smart. And if I say, go and read this or read that, they say, well, it's not relevant. How would you think that we need to have more economic history in what we do?
Let me try that and then go to Catherine. I haven't taught for a while, but I know that students want to know about things that are relevant to their lives and their experience, right? So I think you would have a lot more success teaching about inflation now than you might have 10 years ago. And I think my whole career I've tried to combine macroeconomics with economic history. I think the interwar period is absolutely fascinating. So from a general macro student to understand the puzzle, I got interested in macro because of trying to say the Depression was such a strange thing that all these people, they were killing piglets and throwing milk on the ground and people were starving. What the hell is that? Why did that happen? So that's the kind of thing that gets people excited, to try to understand that. So history is really important in creating examples, and not just American, or you're not American, but in my case, from other countries and other times, Roman hyperinflations and things, whatever. So understanding history is really an important way to motivate. Now, it depends, again, so that's for your general macro student, or perhaps at least to some extent. Now, for your business students, you have to ask yourself, why do they want to study macro? And probably a lot of it has to do with the relationship between macro and financial markets. And if you want to get, maybe you want to put your foot down and say, you got to learn this Keynesian cross anyway, but I think the better thing, probably in terms of getting your teaching ratings high, would be to look at some episodes of financial market, look at the global financial crisis, or look at other periods where there were swings in financial markets that were either caused or causative in the macroeconomy. Why is it that if you're a bondholder, you like to see a weak economy? They want to understand that. So you have to think backwards and say, what is it? Why are they in this class? And to the extent possible, try to relate your work to that motivation. Catherine?
So just a couple of comments. One, just responding to the question about the political influence on the target. I would note that the financial market discipline on the political influence, at least with the change of administration in the UK, was a very important one. And so I'd be curious as to whether or not there was any kind of financial market reaction in New Zealand with some of the changes in the target that you mentioned. On scenarios, which of course are a very important question, and you mentioned your review of the Bank of England's numerous times, and I can tell you we're working very hard to be responsive to that. But on the scenarios, there are two very different kinds of scenarios that you have mentioned. One is taking the structure of the economy as given and shocking it with, say, more fiscal or higher oil prices. That's one type of scenario on which we could have a policy react this way or that way. The second type of scenario is very different, and that is the structure of the economy is different. Like the parameters in the underlying model are different. And we, in our most recent discussions in our monetary policy report, we have focused on cases where there's case 1, case 2, and case 3, which are parameters are different internally in our thought process. People have different parameters in their model. In fact, our models don't have different parameters, but in our minds, we have different parameters. How do you think that having these two different kinds of scenarios that are out there, one is a same model, different shocks, and the other one is, let's say, same shock, different models, is stretching the capacity of our ability to communicate what those scenarios are and how we're going to react. It's kind of like there's a matrix, table, and I just think that stretching our capacity to communicate.
Well,
and I personally think that the parameter differences are way more important than the shocks.
I could agree with you on that. On the first issue about changing the target, yeah, I think the financial markets are an important discipline. And indeed, I've been involved in some debates about whether 2% for the US is too low or not. And I'm saying this, one point that I make is that there's a very big difference from doing this de novo, starting from scratch, and trying to pick the optimal target. The United States has had 2% inflation, with this recent exception, for 30 years. To change it to 3 or 4, as some people have suggested, that transition would be very costly in terms of financial markets, in terms of credibility, et cetera, et cetera. So even if you think 2 is not quite right, you got to have a good reason to change, I think, at this point. On your second question, I talk about both those types of scenarios quite explicitly in my report. I think they're both interesting and valuable, and I don't think it's such a demand on communication, because think about it from the point of view of the person who's hearing it. You're saying, you know, one possibility is, well, we don't know whether the energy prices will stay low or whether they're going to jump up a lot, and you know, how would we respond to that? All right, that's easy to understand. But there's another problem, another thing, which example I gave, which is we see inflation coming down over the next 6 months, but you know, this has been an unusual situation, and we are not sure how quickly inflation will come down. It may be, you know, in economics lingo, have more zero correlation or more persistence than we thought. The average person hearing that is going to say, well, what if inflation just stays higher? To the average person, won't make that distinction. It sounds like just 2 alternative cases. One in which inflation, for some reason, stays higher longer. How would we respond to that? Versus some external identifiable shock occurs, and how would we respond to that? I think they're both very natural ways. Now, I agree that this is going to seem off track. I was around when we created stress tests for banks. And I think they were very helpful in helping us get the banking system stabilized in 2009, very helpful. But I think as a regular supervisory tool, they have to be supplemented, because what you're doing is you're saying, well, here's one particular scenario. It's a scenario analysis. Here's one particular scenario. How would your bank do in that scenario? Well, it's very possible that there's an orthogonal scenario, which would be a disaster. And you can't do every scenario. So that's why, again, that's the problem of choosing the right scenario. You never choose one that is exhaustive. So, but on the other hand, if you do a good job, you'll give at least some idea of what the things you're thinking about. And if you also take the effort to change the monetary policy response in the alternative scenario, you're also giving very important information about the reaction function that, you know, that sophisticated observers will be able to back out from that. So I don't see any problem with that, although I fully concede that doing scenarios in a way that will be intelligible to the public is an art and not so easy. But I think the simple step, even qualitatively, of saying, you know, just emphasizing the uncertainty and the fact that we will respond as needed, and we are not trying to project where the funds rate will be in 2 years. We're instead saying it depends on the circumstances, and here are some of the things we'll be looking at.
So I think we had, was it a question from John? Yep.
Thank you, Adam. John McDermott, another former central banker. Just to address the question that was asked previously. So in New Zealand, we have moved our numerical target on a number of occasions. I've undertaken some research with colleagues on that. And what we found was inflation expectations move almost instantaneously to the movement of the target, where inflation expectations move with quite a lag to other inflation developments. Another comment on the number of scenarios, which I strongly endorse. I think in the past, the Reserve Bank used to engage in scenario analysis. It was always a good idea to put one up, one down, and then you can look at the, you know, how the reaction function moves. I do remember at one time the bank introduced 6 alternative scenarios. I got lots of complaints from financial market participants, so there may actually be an optimal number of alternative scenarios.
It's 2.
It's 2, yeah.
When the expectations changed after those announcements, did long-term bond yields jump too?
Yeah, that was the finding, yeah. And there's some research in New Zealand economic papers on that with colleagues.
There was no complaining about it. I mean,
Markets
the
move.
additional confusion, complication here is that you have a range, and so people could say, well, they moved up the range, but that means they'll just be a little bit lower in the range. No?
Well, I think the important thing was the midpoint of that range moved, and often that's emphasized in the communication. So if you move the midpoint, and that's what markets focus on, that's what the households and businesses focus on, and it moved on.
It's quite an interesting case study, because I offhand, I can't think of another case situation where the target was well established and then changed. I can't, maybe there is, but
case. Yeah, exactly.
Do you have one?
No, that is a unique, New Zealand is a unique case on that one.
New Zealand is always a first among equals.
Take last 2 questions. So we have Gigi at the front here, and then Callista. Callista first, because she's got the microphone already.
Thank you. Thank you, Dr. Bernanke. This is Callista Chung from the Reserve Bank of New Zealand. I'm interested in your views on forward guidance as a monetary policy tool. And, I guess the main mechanism through which it works is by reducing a source of uncertainty in the economy and markets. And do you think it's an effective tool to use, given, the experience through COVID? And also, do you think it's appropriate for the central bank to provide alternative scenarios around forward guidance, or does that kind of defeat the purpose of forward guidance?
Let me try to do it quick. The forward guidance got started when interest rates were close to 0. And the problem was that the public didn't have any idea how to figure out when rates would start to come up. And so the forward guidance was pretty straightforward, which was, we're going to wait until we see such and such, or we think it's going to be a long time, so get rid of your expectations, it's going to happen next month. So that's where it got started, and that's where we had the most sort of unconditional kind of forward guidance. But even after that, when we started talking about we're going to hold rates low until the unemployment rate gets to a certain level, I think forward guidance and scenarios are just work together really well. Because what you're doing is saying, under normal circumstances, away from 0, you don't want to say, we're going to hold interest rates at 4% for the next 3 years. You would never do that. But you might say, here are 3 scenarios, and we are committing, or at least strongly endorsing the idea that if inflation does that, we'll do this, and if inflation does that, we'll do this. So I think that that's the future of forward guidance, is alternative scenarios. And that's, in fact, again, what we did in the latter part of my term, when we tied interest rate changes to specific numerical values for unemployment and inflation.
Thank you, Dr. Bernanke. I'm Gigi from Reserve Bank. So we have just transitioned from very high inflation period to low inflation period. And for most of us, it's almost like the highest inflation they have experienced in their lifetime. So naturally, people pay more attention to inflation and monetary policy now. So my question is, moving forward, do you think this event has a significant enough effect on people's consumption behavior and inflation expectation, and make central banks' job harder, at least in a medium term?
I think there's no doubt that it's going to affect behavior, because like you said, most people don't remember the 70s, right? I mean, to me, it's yesterday, and the 70s was actually quite different in many ways also. It was just a different world. So I think in some ways the the inflation has made inflation control a little harder going forward because, firms will maybe find it easier to raise prices, may see less consumer resistance, people might become more sensitive to inflation and their expectations may adjust more. Now, fortunately, in the 70s, there was endogenous changes in the structure of the economy. For example, the introduction of wage indexation, for example, which I don't know about New Zealand, but the United States has not happened. So that's, from an inflation control perspective, a good thing. So there have been studies, by the way, that look at the participants around the table at the FOMC meetings, and the ones who were adults in the 70s are more hawkish in general than the people who weren't, or younger people. So and everybody knows, and your grandmother who lived in the Depression, would never spend money on some, luxury item, right? Always very big on saving. So yeah, people's behavior is certainly affected by their experience. The Germans still remember the hyperinflation of 1923, for God's sake. So yes, it does affect behavior. We don't know how much. This inflation jump, in some ways, is closer to the post-World War II jump, which was pretty quick. Came up, came down, a lot of supply shock elements. So it may not be a major, we don't know. But I would certainly be open to the idea that people's way of thinking about inflation, et cetera, is certainly responsive to their experience. And indeed, I think what actually happened was such a shock to many people. They didn't understand that this could happen, and they didn't understand what it meant, really. So, yeah, absolutely. And you have to be aware. As a central banker, you need to think about, has the expectation process changed? Do wage policies, have they shortened the period of wage adjustment, for example? So those things can be relevant to policy.
Cool. So thank you, everyone, for the excellent questions. Before you leave the stage, we do just have a small token of our appreciation. So thank you very much, Dr. Bernanke, for the excellent presentation and discussion.